Finance Minister Nirmala Sitharaman is going to present her second pandemic budget tomorrow. And Parliament's budget session, which begins today, will play a crucial role in deciding the future course for the Indian economy. Hello and welcome to the morning show. I'm Nazia Iqbal and you're watching a special budget episode. At a time when the pandemic-battered economy is showing clear signs of recovery, the steps taken by the centre may help it back on its feet. Today, the budget session will start with the tabling of the economic survey, which serves as a precursor to the budget. Watch this segment to know about the expectations from this session. Will it be a stormy or a productive one?
Union Finance Minister Nirmala Sitharaman is set to present the paperless Union Budget for the financial year 2022-23 at 11 a.m. tomorrow. This will be her third budget since taking over as India's first full-time female finance minister in May 2019. And today at 12 p.m., the Economic Survey 2022 will be tabled in the Parliament. The survey acts as an annual report card of the economy and also contains suggestions to the government on policy matters. It is traditionally prepared by the Chief Economic Advisor. This year, however, in the absence of a CEA, the Principal Economic Advisor and other officials are preparing the survey. Similarly, in 2014, the Economic Survey was prepared by Senior Economic Advisor Ila Patnaik and not by Chief Economic Advisor, who is usually the architect of the survey. Meanwhile, the government on Friday announced Dr. V. Anantha Nageswaran as the new Chief Economic Advisor of the country. The post had fallen vacant after Krishnamurthy Subramanian returned to academia after completing his 3-year term on December 6 last year. The last 3 economic survey reports prepared under the guidance of Subramanian were way off the mark in predicting growth numbers. Of late, making GDP projections has become tricky. The pandemic has further complicated it. Last year's economic survey projected a growth rate of 11% for the current financial year. The first advanced estimates put it at 9.2%. In FY20, the economy contracted by 7.3%, while the survey had projected a 6 to 6.5% growth. A Business Daily, while citing officials, claimed that the economic survey could forecast the real economic growth for fiscal 2023 to be lower than the 9.2% estimated for the current financial year. Meanwhile, the budget session starting today with the address of President Ramnath Kovind will be conducted in 2 phases. The first part will go on till February 11, and after over a month in recess, the session will resume on March 14. That will conclude on April 8. The just concluded winter session of the Parliament was a complete washout when it came to economic bills. The government did not table key bills including the one on privatisation of 2 public sector banks and Bharat Petroleum Corporation Limited. And experts believe that the government may not table them in the first half of the budget session due to the same challenge it had faced earlier, the elections in 5 states. Despite the sale of Air India, the government looks all set to miss its disinvestment target of 1.75 trillion rupees for FY22. Apart from privatisation, the implementation of labour codes and the proposed reforms in the power sector are also lined up. Another crucial bill hanging fire is the cryptocurrency and regulation of official digital currency bill, which experts believe is unlikely to be tabled in this session too. Meanwhile, apart from employment-generating measures, the government's fund allotment for the country's healthcare sector will also be keenly watched. Last year, the government had allocated just 1.8% of GDP to health.
The budget session is the longest of the 3 sessions of Parliament, and there are 2 parts. In the first half, the Finance Minister delivers the budget speech in Parliament and any significant tax rate changes or new schemes are announced. What follows after is a general discussion of the budget in the 2 houses. At this stage, the discussion is limited to the broad proposals of the government, and at the end of the discussion, the Finance Minister gives a reply. Parliament then heads into a recess where the 24 standing committees examine the expenditure estimates of individual ministries called as demands in detail. In their examination, they look at the amount of allocation made towards the different programs and schemes under the ministry and how effectively the money has been spent. Each committee submits a report back to Parliament, and the committee's submissions are useful to understand the implications of the expenditure proposed. Once the Parliament is back from recess, Lok Sabha holds a detailed discussion on 4 to 5 demand for grants. The demands taken up for discussion change every year, and the discussion is followed by voting. The demands which have not been discussed are grouped together and voted on the last day in what's called as a guillotine. In the last stages of the process, after the demand for grants are passed, they are consolidated into an appropriation bill. This is the bill which authorizes the government to spend money from the Consolidated Fund of India. Then comes the finance bill, which includes details of tax rate changes. This is considered and passed too. Once Lok Sabha passes the budget, Rajya Sabha only has a recommendatory role in passing the appropriation and finance bills, as they are money bills. So while Lok Sabha discusses the demand for grants, Rajya Sabha spends its time examining the working of a few ministries. As with Lok Sabha, the ministry is taken up for discussion, change from year to year. And that's how Parliament approves the budget every year.
Opposition Congress on Friday said that it will work closely with like-minded parties during the budget session and jointly raise matters of public importance, including farmers' issues and the border dispute with China. Last year, the budget session was cut short by 14 days in the wake of assembly elections in several states. This year too, 5 states, namely Uttar Pradesh, Punjab, Uttarakhand, Manipur and Goa, are going to polls between February 10th and March 7th. With the pandemic affecting low-income segments the most, near-term measures to support incomes and boost household consumption demand are expected from the budget. We may also see some populist measures as polls are in progress. The government is also expected to take steps to generate employment at a time when India's already low rate of workforce participation is falling.
Two of the most important things that will be watched in the Union Budget tomorrow are the Finance Minister's roadmap on bank privatisation and the direction on subsidies. Will subsidies again see a significant upward revision in the revised estimates for 2021-22? How may the government proceed on dilution on its stake in public sector banks and restructuring of regional rural banks? In our next segment, we take a deep dive on these two aspects.
A big item in the FY23 budget to be presented tomorrow will be the food and fertilizer subsidies. In the current financial year, the revised estimates for both these items is expected to go much above their budget estimates. The first is the additional free food grain that the centre is distributing under the Pradhan Mantri Garib Kalyan Ann Yojana as COVID relief. And the second is the additional fertilizer subsidy burden on account of a spike in international rates. Available figures show that the revised estimates for food subsidy in FY 2022 is expected to be around 3.9 trillion rupees against the budget estimate of 2.43 trillion rupees. In case of fertilizers, the revised estimate could be around 1.4 trillion rupees, which is almost 73.5% more than budgeted.
Food subsidies may not decline because the pandemic-related relief may continue. And also off-budget subsidies bringing into the budget also may continue. Similarly, fertilizer subsidies may not decline because the international prices are still higher. And petroleum subsidies also may not decline because petroleum products prices increased, although there is some decline in last 1 or 2 months. Reforms may not be undertaken, particularly in agriculture and the food fertilizer because of the elections in state assemblies soon and also 2024 general election.
As Dr. Mahindra Dev pointed out, bringing any substantial reforms to ensure a meaningful reduction in the centre's subsidy expenditure is unlikely. Unlike petroleum reforms, it is very difficult in food and fertilizer because of the huge political implications that the move might have. In food, reforms can be administered in the following ways: either by lowering the number of beneficiaries covered under the National Food Security Act, or by increasing the rates at which grains are sold through ration shops, or by cutting down an open-ended procurement system so that the pressure on purchases is reduced. No government can take any of these steps with general elections just a few years away. Similarly, in case of fertilizers, any move to align retail prices to market rates could antagonize farmers.
Subsidies, they have, opportunity cost. So instead of giving subsidies, if they are being allocated for investment, especially agri infrastructure, I think these will give more returns than what they are giving right now. If we look to the fertilizer subsidy, the beneficiaries are largely in the favorable environment, especially irrigated environment, and mostly it is going to rice, wheat, and sugarcane. And mostly the large farmers are benefited as a result of this fertilizer subsidy. Rain-fed areas, marginal farmers, small farmers living in marginal areas, hilly areas, backward areas are not benefited much from the fertilizer subsidy, as they are using too little of the fertilizer.
In Budget 2021, the centre had announced its plan to privatize 2 state-owned banks, but it made little progress to implement the plan on the ground. That was because it could not move legislative amendments to enable privatization of public sector lenders, the first step towards privatization, due to COVID-19 pandemic and disruptions in Parliament. According to the proposed amendments that were to be moved in the winter session of the Parliament, the government is to lower the minimum stake it holds in public sector banks to 26% from the previously mandated 51%. The legislation also aimed at empowering the government to make a scheme for privatization of PSBs in consultation with the RBI. The proposed legislation had provisions regarding the disqualification of directors, as well as terms and conditions for service of chairman, whole-time directors, and board of directors.
These banks have been constantly needing government infusion directed from taxpayers' money to support operations. There is an argument that a private control of these banks would stimulate a wholesome, efficient banking system, which would be better prepared to support banking needs of high aspirational economy, limiting demands on government resources. On the legal front, PSUs are governed by Banking Companies Act, which mandates minimum 51% shareholding for government and caps the voting right at 10% for a non-government shareholder, which would require amendments and need to be passed by the Parliament. I think that's the first step. To start with, I think government has infused significant amount of capital, strengthening the balance sheet of some of the weak PSUs. This is likely to make private investment more attractive for some of these banks. However, the bigger question is who could be the potential suitor? One could believe that some large domestic private banks or some foreign banks could be one. However, private banks have generally been lukewarm to the idea of acquiring PSBs, owing to challenge in system integration, HR culture, and policies. Nevertheless, the attraction of ready-made infrastructure and a sizable low-cost deposit base would act as temptation. Government will need to provide full operating flexibility to the acquirer to further improve the appetite.
The government is also to consider changing the foreign direct investment limit in the public sector banks, which is 20% at present. The government has informed Parliament that the Cabinet has not taken any decision on privatisation of 2 state-owned lenders announced in Budget 2021-22. However, the Niti Aayog has reportedly recommended privatisation of Indian Overseas Bank and Central Bank of India. Central Bank of India is likely to be removed from the RBI's prompt corrective action framework soon. The centre is also likely to infuse capital in Central Bank of India and Indian Overseas Bank, which got out of RBI's PCA last September to meet regulatory requirements. Despite the pandemic, public sector banks have reported profits in the ongoing financial year. Impressive raising of capital from the market by PSBs has made the government confident that such lenders are now self-sufficient and may not have to look to the centre for capital in future. PSBs recorded net profit of 31,820 crore rupees in FY21, which has been the highest in the last 5 financial years. With regard to privatizing one public sector insurer, the Niti Aayog has suggested privatization of United India Insurance, the approval to which is yet to be accorded by the Cabinet. Once approved, the DIPAM would start the privatization process of the insurer. Besides this, the government is also looking to restructure the regional rural banking space. A panel was appointed by the centre to suggest turning around of RRBs which has learned to have suggested segregating RRBs into categories based on the capital they require and if infusing funds in them is feasible. The committee's recommendations are with the government, and the finance minister may look at providing a roadmap to turn around regional lenders in tomorrow's budget.
So despite the consolidation which has happened among various regional rural banks, the challenges in terms of their weak operational profile continues, which in turn is because of their weak credit deposit ratio, and weak credit deposit ratio in turn is driven by their capital position, which has remained impacted because of the recent changes in the pension liabilities impacting their provisioning and their profitability. The ability of these banks to raise capital, push for the credit growth, improve credit deposit ratio will be very crucial for these banks to turn around their profitability and their performance. To that extent, the shareholding structure of these banks plays an important role, whereby three shareholders, the sponsor bank, the central government and state government, multiplicity of these shareholders constrain the ability of these banks to raise capital in a timely manner. We have seen that even if, let's say, one shareholder, like a sponsor bank, is willing to put capital, the ability of putting that capital depends on the other shareholders putting that their share of capital in a timely manner. So there have been changes in terms of the revamp of the shareholding structure of these banks, whereby government has proposed a holding company structure, which in turn can enable these banks to raise capital in a timely manner. However, the mechanics, the way the sponsor banks, the state government will transfer their shareholding to the holding company, that needs to be determined to basically maybe finalize or implement this holding company structure.
Budget announcements are usually key drivers for markets, and historical data suggest that stock markets clock a strong post-budget rally if they have booked profits before it. Now, with a 3% fall in the week prior to the budget, benchmark indices are testing their support levels. Here is some insight on key data points that the street is awaiting in the economic survey and union budget.
The two most important economic documents, that is, the economic survey and the budget, will set the near-term tone for the Indian stock market. Economic survey, which essentially gauges the health of the economy, will be tabled in the parliament later today, while the union budget will be presented tomorrow. According to a media report, a single-volume economic survey for 2021-22 will be tabled this time, which could project a growth of around 9% for the next financial year. In recent times, making projections for the next year, particularly for GDP growth, has become tricky. Even before COVID hit the economy, economic surveys in India had been way off the mark in projecting the outlook. Consider this: of the 8 surveys presented during the Modi regime so far, 3 predicted either a somewhat correct number or underestimated the actual growth. 1 was presented when the base year was changed in between. The remaining 4, all presented during the past 4 years, were way off the mark in predicting growth numbers. Now, given that the government's forecasts pertaining to the country's growth hold supreme importance for stock market investors, these projections significantly affect the market sentiment. We have with us Madan Sabnavis, Chief Economist at Bank of Baroda, to understand the key data points that the street will be tracking this time from these two documents.
The first is the economic survey. I think this is going to be important from the point of view of what kind of projections are made for GDP growth in the coming year. Otherwise, most of the information which comes in the economic survey has already been presented in some form or the other. So therefore, there will not be any particular surprises. Now, going over to the budget, I think the budget will be important from the point of view of number one, to see what exactly is going to be the fiscal deficit situation as of 2021-22, as well as what is being planned for the next year. My sense is that there would be a tendency for reduction in the fiscal deficit ratio by at least 0.5% of GDP for 23 against the revised number for 2021-22. Now, within the internals, I think the areas of interest as an economist would be about what would be happening to capex. We have seen a lot of calls from analysts, economists, as well as industry for greater expenditure on capital expenditure. But here I think there are certain limitations given the size of the deficit, the size of the budget. I would not be expecting more than maybe around 8 to 10% increase in overall capital expenditure. Now, the numbers on GDP growth are again important, and we would tend to believe that it would be in the region of around 13% for 22-23, because this will be the basis on which there would be the calculations made for various taxes, especially corporate tax, GST collections, and to a certain extent also customs and income tax. This year, I think the government has said that disinvestment of LIC would take place, and that will probably happen. If that happens, one should remember that this lever of getting around 1 lakh crores will again not be available for 22-23, and therefore we'll have to probably go along with a smaller number for disinvestment for 22-23.
On their part, investors are starting off this week with lighter portfolios after a heavy bout of selling over the previous week. The BSE Sensex and the Nifty 50 declined 3% last week as profit booking ahead of the budget along with global headwinds kept investors on the sidelines. Let's go to Business Standard's Avdhut Bakkar to know how to play the markets ahead of the budget.
The recent correction has seen both the indices, BSE Sensex and Nifty, dropping below the most crucial support of 17,000 for Nifty and 57,000 for BSE Sensex. However, the intraday weakness could not hold the bearish sentiments, and both the indices managed to recover and close above this sentimental level. Now, both the indices need to cross the selling range of 59,000 for Sensex and 17,700 for Nifty. The overall trend suggests that indices are in bullish territory as long as the crucial support of 57,000 and 17,000 are held decisively. For Nifty Bank, as of now, there is a formation of inverse head and shoulder which has a breakout at 39,000. If this index manages to conquer that, then one cannot neglect the possibility of Nifty Bank claiming a new level of 42,000, which is going to be a new all-time high.
Clearly, markets are at their make or break levels, and budget will now hold the key for the next decisive move in the indices. Apart from the budget and the economic survey, Q3 earnings will keep stock-specific action alive on the street this week. DLF, Hindustan Petroleum, Indian Oil Corporation, Sun Pharma, Tata Motors, Adani Ports, TechM, HDFC, Titan, Paytm, Bank of Baroda, and State Bank of India are some of the prominent companies which will report their December quarter results this week. In the primary market, Vedant Fashions Limited, which owns ethnic wear brand Manyavar, will launch its initial public offering on Friday, February 4th. Globally, FII activity, oil prices, and bond yields will decide the movement in equities.
When the finance minister presents the budget, all eyes are on a document that shows the total expenditure of the government. It is called Expenditure Budget. Why is it important? Here's an explainer to help you understand. Part of the Union Budget, Expenditure Budget offers a complete picture of the government's expenditure in any financial year. This exhaustive document tells us about various types of outlay and reasons for the variations in estimates. It shows the funds allocated for disbursement to the different ministries and departments during a financial year. These allotments are made under plan and non-plan estimates. Expenditure budget is classified into two broad categories: capital expenditure and revenue expenditure. Capital expenditure is the amount spent on creating assets. It is a cause for a reduction in the government's liabilities. It adds to the capital stock of the economy and is non-recurring in nature. It also includes loans given to states and union territories, along with repayment of borrowings. And any expenditure that neither creates assets nor causes a reduction in liability for the government is known as revenue expenditure. It is recurring in nature and is incurred on the normal functioning of the government. While the former results in the creation of a physical asset or investment, the latter comprises mainly operational expenses. Payment of salaries, pension, interest, expenditure on administration, defense, health, and other services in the country come under revenue expenditure. The government prepares its expenditure-related information in 3 separate documents. The first is the expenditure profile. It compiles data from all the ministries and departments to draw a complete picture of the financial performance of the union government. It serves as an explanatory document that aids economic analysis. The statements contained in this document are based on data provided by the ministries. Some of the statements are also based on the data provided in the expenditure budget. The second is the demand for grants. The demand for grants is a document in which the estimates of expenditure made from the Consolidated Fund of India are submitted in pursuance with Article 113 of the Constitution. Included in the annual financial statement, they are required to be voted upon in the Lok Sabha. And the third and final one is the expenditure budget. It deals with both capital and revenue expenditure. This year's budget will be a statement on how the country's bruised economy will crawl back to its feet and what the government intends to do to make it run. Hope you enjoyed this budget special episode of the morning show. We will be back tomorrow with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.